starting with a brief run through of markets, equities, currencies, commodities. The last 5 days in the equity space, a bit of a mess. Pretty much sideways with a lot of volatility in Chinese equities for reasons that we've already talked about. Going into last week, the end of last week, just about here, we had a big run up in Chinese equities as the swap lines opened, which allowed corporates to swap more than likely underperforming or bad debts to some extent for fresh, shiny new cash that they could then go and invest in buybacks or buying back their own stock or increasing their own longs or buying somebody else's stock. Understandably, when that came online, equities went up and got a little bit of a boost. But it didn't last very long. There's disappointment that we didn't get much news over the weekend of new stimulus, and that impact is fading, as we can see at the start of this week in Monday. Yesterday, say through last week, a lot of back and forth, but really not much movement. You can see that over the last 5 days, the major indices, the Nasdaq, the S&P, the European index, the Euro stocks are all pretty much flat. Up or down a little bit less than 1%, standout being Russell 2000, which took a dive yesterday on worse than expected economic data. So Russell, a bit of a sell-off. Russell was one of the assets, small cap companies, which Russell 2000 is comprised of 2,000 small caps. One of those areas of the market that seemed to benefit potentially from a Trump win, but positioning was high. So maybe a little bit of positioning adjustment there. But yesterday, the main story of the last 5 days probably been the underperformance of Russell and the lack of follow through on the Chinese stimulus. In dollar space, a much clearer picture, broad dollar strength, in particular against the carry trades in Mexico and Poland. But DXY is the broad dollar index. You can see that's up on the week, just under 1%. Sterling up under 1% as well. So most of the main dollar crosses are up, with particularly large outperformance on the carry trades. Again, that's seen by some to be a reflection of funds and people pre-positioning for a Trump win. And the dollar strength that have ensued before. I expect it's also interrelated with US interest rates, 10-year interest rates. Well, the whole US interest rate complex actually just moving higher, and the data continuing to support the soft landing view, and therefore interest rate cuts being priced out. So there's a whole bunch of stuff going on, but it's all broadly dollar positive. And moving on to the next slide. In commodity space, not such a good week for oil. Oil down 1.5%. You see the CRB RINs also down, and TSI, the Chinese linked index, also down. So I think that's just reflecting, not reflecting anything about global growth, but I think it's more the disappointment that Chinese stimulus has not really taken hold as much as the market might have hoped. It's just illustrating that, just with a view on the Chinese indices themselves over the week. FXI being the ETF, the large cap onshore Chinese large cap ETF that you can trade in the US. You can trade options on that. We've looked at that before. Purple line just HSI futures, and the blue line is an onshore Chinese index. So quite a lot of ups and downs, but really going nowhere. And I'd expect that to continue at least until probably into the National People's Congress, until we're likely to get potentially some more detail out of that. But we've seen in flow space, money moving out of China, moving hedge funds actually going net short China. So I think that the China story for now is probably on the back burner as we turn our attention to the elections, and indeed gold and commodities in general. I thought this was an interesting chart. It's just showing you the last 5 days in gold, positive as we know. That's the gold future. But something special happened in the silver market on Friday. You can see it's just tracking gold all the way along here. This is Friday. This is Thursday. This is Wednesday. So Wednesday, Thursday, everything is normal. Gold is tracking silver, and this is just about here, just around about there is the close in the European session, and there was a huge, quite phenomenal short squeeze in silver into the close on Friday. You can see it tipped 5% above gold. These things happen sometimes in the silver markets. We call them short gamma pockets, but whatever is going on in silver, there's a huge amount of buying on Friday, and that seems to have carried through. A little bit of consolidation yesterday with a bit of a drop off that we saw in gold as well, but today we're moving higher. And we're talking about gold quite a bit recently, and I dug into what some of the drivers of gold higher might be over the next few months. So we'll cover that a little bit later. But I think it's an interesting story around gold at the moment, and quite a few things have changed. I know, Mika, you were asking about gold's dollar interest rate correlation, so we'll get to that a little bit later as well. Yeah, some bonus charts on gold for you later. Moving on, yeah, there's just another chart of gold. Some people have been, I've seen some news articles mentioning the open interest growing in the gold futures. This is GC1 exclamation. That's the front month gold future on TradingView. Below here, we've got a rolling open interest chart going back to about the last 10 years. These big drops are because this is the front month contract. So at some point that contract starts to roll into the next one and the open interest drops and typically comes back down again. So ignore these big sort of drops. It's more we're trying to follow this general trend here. And we see that open interest has definitely been on an uptrend since about July. Last time we saw something like that was actually in the teeth of COVID. Just before COVID, we had a similar big uptrend. Gold did a similar thing, went up, and a little bit later we'll look at why that is. But just to note that open interest is growing in the gold futures market, and that tends to be correlated with gold going higher. In terms of flows, a lot of outflows in the last week, but that follows sort of headlines. Biggest outflow from EM equities, biggest outflow from Chinese equities, largest outflow from tech. But all of these outflows last week followed massive inflows the week before. So if you see any headlines this week about big outflows from tech and EM and all that, just remember that that's on a weekly basis. The week before, we had some of the biggest ever flows. So I don't think there's anything there's certainly nothing negative from flows. We'll see a little bit later some positive data around flows. I think what is clear is that there's definitely consistent inflow into bond markets. One would expect that given the fact that yields are moving higher. In volatility space, it remains elevated. Skew is very elevated. We've talked about skew before as this idea that implied volatility is not constant across option strikes. So if you have call options on the right, put options on the left, the 25 delta puts and the 25 delta calls, indeed the at the money, will all have a different volatility. And remembering that volatility, implied volatility, is how a market maker adjusts the price of an option to be cheaper relative to what he sees as its fair value. So typically in indices, we see a chart that looks a little bit like this, where put vol is higher than call vol. That's the norm in indices, and you can rationalize that with by just understanding that what most investors, institutional and to some extent retail, use put options for on the S&P or use options on S&P and Russell, and that particularly in the put space is to protect their portfolio. So there's this constant demand for protection. which sees typically puts trading more expensive than calls. So that's nothing unusual to see a skew in the market puts above calls. But what is unusual at the market at the moment is just the extent of that. So this is where's my pen gone? This chart down the bottom, everybody owns US equities downside, left tail. Here is just showing us that skew metric for the two different approaches. This is what we talked about, puts versus calls. You see 25 delta put versus 25 delta call. Over the last year, we're in the 96th percentile. Our puts versus at the money is also in the 98th percentile. So heavy demand for put options from somebody or other. Someone is paying up for them. Skew is very high. The volatility of VIX options, VVIX, we've talked about that before. VIX options are relatively expensive as well, relative to the price of the VIX. So while there's a lot of positivity around in the dollar market and equity markets, there's on the flip side a lot of positioning for downside. This sort of thing is not unusual going into an election, in the sense that typically elections are volatile. And also it's a year where we've had some pretty big equity outperformance. So that's less unusual to some extent. But we'll get a little bit later to why it's interesting. But certainly the case that people are not all in on this rally. I would say there's a lot of protection in place. There's a lot of hedging in place. Things that did outperform last week were the kind of I wouldn't quite say trash, but kind of regional banking index, high short interest, most shorted non-profitable tech, most short rolling, high yield debt sensitivity, real estate. These are all things. These are thematic baskets that the banks put together. So everything that starts with GS is Goldman's. So they'll try to find a theme like which tech companies are not profitable. So they'll put together a basket of unprofitable tech. Yeah. And you can see year to date, that's down 7%, but last week it was up 2.8%. They've got which stocks are most shorted by hedge funds, where's the pain trade. So this is our most liquid short basket. You can see on the year that's up 24%, been a tough year to short stocks. But again, up strong last week, high short interest up. So a sort of sideways week last week in broad equity markets, but this kind of trashy, unloved stuff had a pretty good week. I think that's evidence of that sort of growing optimism around US elections. It's just another chart on VIX. We just inverted VIX here. VIX, this is VIX scale. This is the equity scale. So it just shows that generally as equities go up, VIX goes down. But what's been happening recently is actually equities up, VIX up, and has sort of stayed around these levels. So that's the election premium, and maybe that demand for downside. Although if we look at VIX itself, Friday was a big expiration, so that was the last expiration before the election. We saw a significant amount of open interest drop off. Just some numbers there from Goldman's, just to impress on you. Just the size of these expirations: 1.5 trillion in notional rolling off on the S&P. A huge chunk of VIX calls rolling off as well, and that's led to the open interest on VIX call options being at a 2-year low point. So a bit of a disconnect there, I suppose, in the sense that VIX itself skew is relatively well bid, but VIX call options are very, very low participation at the moment. And that sort of speaks to this to some extent. This is a chart of, I won't spend too long on it, but typically we generally see volatility goes up when equities fall. That's the sort of normal thing. So S&P down, VIX up, right? But we also have times where call option volatility goes up as equities go up. We call that positive spot vol correlation, and it tends to happen in these sort of periods. You can see this is the S&P 1 month return. When we've had a high 1 month return the month before, call options tend to get bid. You can see all of these circled areas here, here. So our last 1 month return on S&P was pretty high, but call options and vol is not really moving. It's really cheap at the moment. It's around 11, 12, which you've probably seen if you're trying to do bear call spreads. You're not getting paid very much for it. So that's kind of interesting. Nobody is chasing the rally yet using index call options, and maybe that's an opportunity. Another interesting chart from Goldman's. This is from their prime brokerage business. Remember, prime brokerage is where an investment bank lends money to hedge funds for leverage to invest. So the benefit of that is they get to see inside the kimono, as they say, as they like to say. They get to see what's behind what's under the covers, what's everybody doing, and they share that data in an aggregated format with their clients with these sort of charts. And what's been happening is, at least from Goldman Sachs Prime Book, which we can probably confidently say is representative of the market, is their clients, their leverage clients, have been selling out, have been reducing their positioning in Mag 7, even as the NASDAQ goes up. Not saying that's got any predictive power, but it's just, again, another point to say people are not overly invested in what's been making money recently. If anything, broad professional institutional investors are potentially caught on the hop with too many hedges in place and not enough upside in place. Would be how we read that. So that's, if you're looking for how can equities advance from here, well, positioning is not extreme, and we're just about to go through peak blackout periods for buybacks. As companies have earnings coming up, they're not allowed to buy their own stock, which is kind of sensible, I would suggest. But we're coming out of that earnings period. We're in the earnings period. So as soon as earnings are announced, those companies are now allowed to go back into the market and buy their own stock. And this is just a chart of peak blackout periods with 80% of companies. Blackout is just about to roll off as we roll into November, as we roll into the US elections, and the size of buybacks this year is significant. You see that almost $1 trillion worth of buybacks, and this is billions, percentage change year on year. So up 21% this year versus last year, which was down, and Goldman's predict that goes up again. You can see there's an upward trend here, and no surprise that when debt was extremely cheap, companies made financial sense for companies and CFOs to borrow money and buy the company's stock, didn't it? But despite the fact that interest rates are higher, they're still engaging in buybacks, and that's projected to grow even into next year. So again, another potential tailwind for markets. This is just a chart that shows you that those buybacks, if we split them out by sector, unsurprisingly, very much concentrated on financials and tech. And it's just a little chart that shows probably overestimates, to be honest, the impact of buybacks, but it does just show you that where buybacks are continuing at the same time they generally do every year. November is typically the biggest month of the year for buybacks, so we're coming into that peak month of the year for buybacks, and we got a lot of other positive tailwinds for markets. People are not overly invested. Funds have been pulling out of Mag 7, so everything looks set up for a year-end rally, except there always has to be one but. I don't think it's a game changer or it's a killer, but it is worth just being aware that fund managers, so institutional investors, Bank of America, do this global fund manager survey. So literally, what they do is they'll send out an email to portfolio managers and fund managers around the world once every month, and they ask them a series of questions, things like, have you increased or decreased your equity exposure? What are your cash levels? All these type of things to try to get a feel for what are people doing, what are they thinking they're going to do. And this is just a chart for cash level as a percentage of AUM, and that's a proxy for risk. The less cash you have available, the more you are invested. You've obviously used that cash, you put it somewhere. We don't know whether they put that cash into bonds or they put that cash into equities, so it's not quite the same as saying over this period, fund managers have been buying equities because the cash levels have dropped. Just remember, they can buy bonds as well. They can buy lots of things. It's not just equities. But in the past, when we've seen cash levels get this low, they tend not to have gone lower. They do tend to go back up again. And it's not a bad sell signal, shall we say. You can see that since 2011, there's been 11 prior signals, and in the one month after, global equities have been down. So that's just one thing to be aware of. There's lots and lots of positivity out there, maybe a little bit too much. People are well hedged. They're not chasing the market higher. We do have buybacks coming in. If anything, positioning in Mag 7 is lower, but broad positioning maybe is a little bit more risk on than one would expect going into an election. So that's just one thing to be aware of in flow space. Speaking about elections, I think probably all aware of the general trends, with probability rising for either a Trump sweep or a red sweep, or a Trump winning. And that's been reflected to some extent in market returns. And you can see this is, again, Bank of America have just plotted the 2024 election returns and the 1 month after the 2016 election, just to show some level of similarity. These are sort of seen as, some of these are seen as Trump trades. One thing I would point out is expectations matter. Going into the 2016 election, Trump was seen as being negative for equities. That was the consensus view. And indeed, immediately he came in, you did see gold sell off. You did actually see equities sell off immediately, and then it flipped right to positive. So I think I wouldn't say it's disingenuous, but you do have to remember that the expectations going into this period were very different from this period. Nevertheless, once we realized what was going on the month afterwards, we all re-engaged and we bought risk, and that's what happened. And that seems to be what's happening now. And as again, I'm sure we're all aware, government spending just keeps on going up, and regardless of who gets in, that is probably not going to change. These odds here come from sort of betting markets. We talked before about why prices are not probabilities. So just to be aware that big players in things like Polymarket can shift the odds. But even Nate Silver's work has shown Trump pulling ahead, albeit within a very clear margin of error, basically neck and neck. But you can certainly see the trend has been moving in Trump's favor. So maybe there is something in that, and it isn't just people distorting the market with big bets. Hedge funds certainly seem to think so. Just a few charts here, I won't linger on them, but again, the big banks, where this is JP Morgan, Goldman's have got one too. They have all of these baskets. So they have baskets of stocks that they think will do well if the Republicans win. They've got baskets of stocks they think will do well if the Democrats win. And these charts are just showing you that those baskets have been performing. I'm not saying that's necessarily prediction of has any predictive power, but certainly those baskets have been performing in line with the probability of wind going up, and positioning in those baskets has been increasing as well, which tends to suggest that perhaps hedge funds are increasing their bets on things that will make money if Trump wins, and decreasing their bets on things that will make money if the Democrats win. So the odds seem to be suggesting that, and it does look like some people are putting money behind that trade. That's one reason it gets going. We had one question before about what does well in a red sweep. Renewables don't, that's for sure. Financials, growth stocks, possibly crypto, but certainly not renewables. But interesting to see, there's been no real discernible flow into crypto. So only a weak flow into crypto. But in general, as we talked about, ETF flows very positive last week, in the past week, just in the broad market. Yeah, and that's just another one of these baskets from, I think, either Goldman's or JP Morgan, just another one just showing again this somewhat divergence in fortunes with the Republicans. I mean, to be fair, the Republican victory basket's been doing pretty well since the Fed rate cut, so I think there might be an element of rising interest rates and improving growth outlook rather than anything to do with Trump, but there you go. It's another one. I won't linger on this at all. You can go back and watch the video if you want to go through this, but I just stuck this slide in to show you that a lot of people are, you know, we look at these baskets and we say, yeah, Trump trades are doing well, this is doing well, and we all sort of claim to know more or less accurately what's going to happen if there's a red sweep. But this is Deutsche Bank basically asking their economists, asking their traders, their equity investors across, you know, various different outcomes. What do they think will happen? And I'm not going to go through it all because the result is broadly, we don't really have much of a clue. It's certainly, I think the clearest thing from Deutsche Bank is that in a red sweep, the dollar will do very well against these carry trade currencies. In a blue sweep, emerging market FX will do well. My cat seems to have an opinion, but I don't speak top language, so I don't know what that is. Yeah, she can shut up. And yeah, we've got a few other things in here, like S&P probably higher on a red sweep. To be honest, I'd be more optimistic than that. I think red sweep S&P is definitely going a lot higher. But it is the trade-off between Trump and a red sweep is if it's just Trump, then there's an impact. Move the cat out of the way. There's tariffs are likely to be negative, so Trump's going to bring in more tariffs. That's going to be negative. He'll probably extend tax cuts. But if it's just Trump and there isn't a red sweep, he may not be able to do enough fiscal stimulus to offset the negatives that come with it. So there's a bit of a nuance there between Trump winning or a red sweep. And again, we could spend an hour going through all of that, and I'm not sure we'd be any more the wiser. Finishing up with gold, it's a nice little chart, I guess, from Michael Hartnett at Bank of America. Michael's always got something to say. He's not always right, but he's always interesting. He's been in the news a bit recently because he put out a piece over the weekend, gold to 3,000, and this is one of his charts. And he making the point that, you know, the 2020s have been a decade of fiscal and government excess, much more so than what we've seen before, and that, you know, gold, one of the sort of rationales for holding gold is as a hedge against debasement, against inflation. So, you know, I guess the argument he's positing is that part of the tailwind for gold is just the government's being fiscally irresponsible, and therefore, you know, people may want to hold more gold. I think the other elements, and perhaps more importantly for gold, and that's just a chart just showing you if you like regressions, that you can just about draw a line to show there's a relationship between the US federal deficit and change in price of gold. I don't know, see what you want to see there, but there's an element of that. This is more interesting. The gold price tended to correlate quite well with flows in ETFs because ETFs that are backed by physical gold, if more investors invest in those ETFs, they need to put more gold bars in a vault somewhere. It's literally like there's literally these big ETFs have got vaults with JP Morgan in London, Standard Chart, HSBC have got big gold vaults too. The JP Morgan gold vaults are just below the JP Morgan building on the embankment, if you know that building. So a lot of gold under there. A lot of interesting trucks coming and going. I'm sure at one point, Zero Hedge, or some people were like were monitoring how many gold trucks were coming in and out of Brinks-Mat trucks were coming in and out of the JP Morgan building. But yeah, just a bit of factoid there. But yeah, when investors buy ETFs, ETFs need to buy gold, and therefore it was seen as reasonable that as these ETF flows, these are metric tons on the left-hand side, as the gold ETF holdings went up, the gold price, all else being equal, should also go up because a large source of demand. But something different happens in 2022. These ETF flows, ETFs dropped, probably because gold went absolutely nowhere for a very long time period. So people just got fed up and retail just decided, okay, gold is not going to $3,000 or $2,000 anytime soon. So they got fed up and sold out. But the gold price continued going up. And something else happened around that time. The US weaponized the dollar, but Russian reserve currencies were frozen. So Russian dollar holdings outside of Russia were frozen at various different central banks, and unsurprisingly, then other central banks went, okay, maybe we should not hold so much of our reserves in dollars at other central banks because it could be frozen, and we'll start buying gold. And that's definitely been a very strong flow for the last 2 years. Has been central banks around the world increasing their gold holdings. Some of it is public, most of it is not public. So it's very hard to discern exactly what they're doing unless they tell us. But one thing that is clear is if you look at this gold managed money futures net, which is a bit of a mouthful, but it's just telling us about the open interest and the flow in gold futures, which is what hedge funds will use to buy gold, but also what central bank also will indicate some central bank activity. That's been going up, and that correlates very nicely with the rally in gold. So maybe something has changed with gold, and definitely something has changed in relation to its correlation with interest rates. Again, another argument for gold as it relates to interest rates and inflation is related to real rates. So, you know, gold is an asset that pays nothing. It doesn't generate any interest for you. It's all about price appreciation. So, from an investor's point of view, if you think, do I buy gold in the expectation that the price goes higher over the next year, or do I buy bonds where I get paid X over the next year? So at the moment, bonds pay you about 5% in the US. Gold's done 30% this year, so clearly that was a good trade. But you have to inflation adjust the bond payment, of course, because bonds might pay you 5% over a year, but if inflation is 7% over a year, you're going to be worse off, right? So that's why we often look at gold versus what we call real yield, which is just the inflation linked bonds adjusted for nominal yields. But it's just telling you kind of, okay, we know if we buy gilts, we get paid 3-4% a year, but what if inflation is 5% a year? The combination of the two is like -1. So that's what we've got here. So you see when real yields when it's a losing trade to buy bonds, given where inflation is, gold tends to go up, and that makes sense. If you're not getting paid anything, if you're actually losing money, inflation adjusted by putting your money in bonds, well, maybe gold's not a bad place to put it. So typically, that's what we see when real rates fall, gold goes up. But what's happened recently since the Fed started hiking interest rate is real rates have gone up, and they're now positive 2%. So you can now generate a positive real return of 2%, inflation adjusted, risk-free, holding US debt. But gold is still going up. So that correlation between gold, inflation, and interest rates completely broke down just about when the central banks froze Russian assets. So again, it seems to back up the theory that the part of this rallying gold, this decoupling from traditional correlations, is due to central banks. As you say, gold purchases by EM central banks concerned about US financial sanctions. And I don't have a chart in it, but that plays into the BRICS meeting, which is coming up in a week or a couple of weeks' time. So a lot of people perhaps expecting gold to go higher into that. I'm not so sure, because these guys have been buying all the way through. One last chart. Again, you see these forecasts around Hartnett gold at 3,000. You might have seen a headline, Goldman's gold at 2,900. The way they're coming up with that is partly this rising ETF flows, moderating but still significant central bank purchases, and this rule of thumb that a 25 basis point decline in the Fed policy rate by Goldman's analysis, and I had no reason to doubt it because they're not trying to sell me anything. By Goldman's analysis, a 25 bip decline in US interest rates does not immediately impact gold prices, or it doesn't, or at least it doesn't immediately impact gold holdings in ETFs. It takes a while for that to filter through. So after 6 months, on average, you could expect 60 tons of demand based on a 25 bip cut. Could be as much as 100 tons of demand. And then this is a bit more of a believable regression. I think you can see that sort of line. But yeah, there's this 100 tons of physical demand in a month can lift gold by 2.5%. So it's a little bit of mathematical gymnastics by Goldman's to justify a price target. But to be honest, given the sort of analysis people used to do on what moves gold prices, this is far better than anything you would have seen 2, 3, 4 years ago. It's just such a difficult thing to value that this makes sense to me. And the reason we went through this, because I said before a couple of weeks ago, don't buy gold because it's overbought. Wait till it comes back to the 20-day moving average. Even when it came back, the fact that interest rate cuts were being priced out to me was a negative. But having dug into it, and yeah, it did well this year, but year on year, gold can have multiple up years. So just because this year was a good year doesn't mean next year is not going to be a good year. And just this continuation of flows into gold from central banks, I think if we do get a Trump victory, yeah, we could see gold higher into the end of the year. Whether it's 2,900, whether it's $3,000, I don't know. But there's definitely some reasonable reasons from here, I think, for upside in gold. We've looked at these before. If we wanted to zero in on something that works well for gold into the US election, I think this call spread looks quite nice. It's got a maximum payoff ratio of 800%, but more importantly, for gold, up to about 267 on GLD, we make what's that, close to 350%, and it just captures the 2 weeks immediately after the election. So again, if it's a red sweep, I'd expect gold to go up. If it's a contested election, and all of the evidence seems to be, well, no, I don't think anyone's be surprised that Trump will contest the election. but there's also noises building that the Democrats might also contest the election this time around. So it could be a bit of a messy 2-week period post the election if it's not a clear result, or even if it is a clear result. Someone decides to argue with it or bring legal challenge, and that would be very beneficial for gold. So normally I'd do debit spreads probably out in December, but by rolling the strikes in a bit closer, because we've got this event risk, we position quite nicely for that, I think. And also remembering with the debit spreads, once we get through the strikes, our volatility exposure is minimal. But vol is not particularly high in gold, so I think that's an interesting trade. One more chart before we move to questions. A really simple one, just pointing out the upside volatility on call options we saw before. Everybody's hedged, nobody owns the upside, there's no demand for the upside. Vol is super low on these 10, 13 delta calls. It's down at 11. It really doesn't get any lower. I'm not saying it's going to go up. I'm not saying equities are going to go up, but as a little sort of, if you wanted to play a end of year melt up and you're confident that that's the direction the markets are going in, just simply buying 20th of December, 620, maybe 610, maybe 625 call options at this volatility looks pretty good to me. And that's because if we get a jump in volatility because people start chasing the rally, this sort of thing happens. Look. So the danger with long call options is this dashed line, right? I've got 60 days to go on that, but after 30 days, I need SPY above 610 to make any money because of time decay, right? But if volatility adjusts to something more normal, there. Actually, my break even has gone the other way. Now I'm in money right away because vol's gone up, and my break even today drops to 560, and halfway through, I only need SPY above 6,000 to make money. So 18% vol on upside call options is relatively high, but that's just showing that you can be in a position now to have a bullish trade on SPY, where it's unusual that we've seen such a rally in equities as we saw in that spot vol chart, and for call options to be so unloved, and that's probably just reflective of people being cautious into the election. But if it is a positive market outcome, those call options will rip and volatility will probably move higher. And you can see for a investment of $186, you could make some quite chunky multiple returns there. And obviously, what I would do in this, if we did see vol up and we did see the market up, I'd probably immediately, quite quickly, turn it into a call spread to take profit on it. It's not. I'm certainly not positing a view that I expect SPY to be well above 620 at the end of the year. That this is a cheap way to position for a decent move in November, and then you want to be out or you want to take profit. It's not a buy and hold into the end of the year. We're really buying it with the view that vol is going to go up, the equity market is going to go up.